James opened his banking app on a Friday afternoon and counted 6 accounts staring back at him. A checking account he used daily. A savings account at the same bank earning almost nothing. A high-yield savings account he had opened after watching a finance video 18 months ago and then forgotten to actually fund. A brokerage account with $412 in it from a brief period when he thought he was going to become an active investor. A credit union account from his college years that still held $67. And a second checking account he had opened for a side project that never got off the ground. 6 accounts, no clear system. A net worth he could not calculate without a spreadsheet and a lot of hunting. His colleague Ryan had 1 checking account, 1 high-yield savings account, and 1 retirement account. That was everything. Ryan could tell you his net worth in approximately 30 seconds. His emergency fund was fully funded. His retirement contribution was automated. His monthly bills paid themselves. He did not think about money particularly often because the system he had built was simple enough to run without him. Same job, same city, same general income range. Ryan did not have more financial discipline than James. He had less financial complexity. And in the current economic environment, less complexity turns out to be the decisive advantage. This video is about the minimalist money habits that produce that kind of financial stability. Habits that reduce the number of decisions, eliminate the number of failure points, and eventually build a system that runs on its own while you focus on actually living your life. The personal finance industry has spent decades persuading people that financial success requires sophisticated systems, multiple accounts optimized for specific purposes, rotating credit card strategies for maximum rewards, active portfolio management, tactical allocation shifts based on market conditions. The data on how this approach performs for average households is uncomfortable. Americans are carrying record levels of household debt. Emergency fund coverage has declined to historic lows. A majority of adults cannot handle a 4-figure unexpected expense from savings. More than a third of households cannot cover 3 months of basic expenses by any means available. These are not people who lack access to financial information. Many of them follow finance content, use budgeting apps, and have a working understanding of the concepts. The complexity of their financial lives is part of what is defeating them. Minimalist money habits work on a different principle. They reduce the surface area where financial decisions can go wrong. They lower the cognitive cost of each individual choice until the choices become automatic. They create a system simple enough that it does not break down when life gets complicated, which life does, reliably and without advance notice. James's 6-account situation was not just inefficient, it was cognitively expensive. Every time he made a financial decision, some part of his brain was carrying the overhead of tracking 6 separate balances, remembering which card was connected to which subscription, and calculating whether moving money between accounts made sense. That overhead does not announce itself, but it accumulates into the low-grade financial fog that prevents clear thinking about money. Ryan's 1 checking, 1 savings approach eliminated the fog. Every dollar had an obvious home. Every decision had an obvious answer. The simplicity produced clarity, and clarity produced consistency. Habit 1. Build the 2-account foundation. The starting point for minimalist money is consolidating to the smallest number of accounts that still serves every necessary function. For most people, that is 2. 1 checking account for daily transactions and bill payment, and 1 high-yield savings account at a different institution for emergency fund and short-term savings. The high-yield distinction matters more than it sounds. Traditional savings accounts at major banks currently pay rates near the FDIC average of less than 0.5% annually. High-yield savings accounts at online institutions are paying 3 to 5% annually in the current rate environment. On a fully funded emergency fund of $10,000 to $15,000, that difference represents several $100s per year in earned interest, money that accumulates without any additional effort or decision. The consolidation itself is the habit. James spent one Saturday afternoon closing the college credit union account, the forgotten high-yield account he had never funded, and the dormant side project checking account. He transferred everything into a single checking account and a single high-yield savings account that he linked together. By Sunday morning, he could tell you his complete financial position in under a minute. The simplification took one afternoon and produced ongoing clarity that required no maintenance.
Habit 2. Automate savings before spending begins. The default financial sequence most households operate on runs like this. Income arrives, bills get paid, spending happens throughout the month, and whatever survives gets saved. The predictable result is that almost nothing survives. Spending naturally expands to fill whatever space the checking account provides. The minimalist inversion treats savings as the first bill paid, not the last consideration after everything else. The moment income arrives, an automatic transfer moves a fixed amount directly to the high-yield savings account before any discretionary spending begins. The checking balance that remains becomes the operating budget. Lifestyle adjusts to that smaller number rather than to the full paycheck. This works because it removes willpower from the equation entirely. There is no monthly decision about whether to save and how much. The transfer happens automatically, the same way a utility payment processes, before any choice is possible. James set up his automated transfer at $75 per paycheck when he first implemented it, a number that felt manageable. Within 4 months, he had increased it twice. The lifestyle adjustment happened both times without significant friction because the money was gone before he registered it as available. The same principle applies to retirement contributions, which operate at an even more powerful scale. A 401k contribution set once in a payroll system removes money before it ever reaches the checking account. The tax benefit compounds the advantage further. The minimalist habit is to set the contribution rate once and leave it alone, increasing it by 1 percentage point each year until hitting the contribution maximum. Habit 3. The purchase delay. Every non-essential purchase above a personal threshold, $50 is a reasonable starting point, waits 24 hours before the transaction is completed. The item goes in the cart, the tab stays open, the store visit ends without the purchase. If the desire is still present the following day, the purchase proceeds. If it has faded, the cart gets cleared. This habit interrupts the specific psychological mechanism that drives most unnecessary spending. Impulse purchases are almost never about the item itself. They are about an emotional state. Boredom, restlessness, social comparison, the ambient discomfort of a difficult afternoon that the brain has learned to temporarily relieve through acquisition. 24 hours is enough time for the emotional state to resolve through other means. The desire for the item typically resolves with it. Modern retail environments are engineered specifically to eliminate this gap. One-tap purchasing, saved payment credentials, countdown timers on sales, and buy now, pay later options at every checkout exist to compress the interval between wanting something and owning it as close to zero as possible. The purchase delay is a deliberate restoration of the gap that the retail experience systematically removes. James tracked his purchase delay outcomes for 60 days after implementing the habit. Of the 31 items he added to various carts during that period, 22 were still desired after 24 hours, and 9 had been forgotten or reconsidered.
9 unnecessary purchases avoided, representing roughly $400 in a single 2-month window. Habit 4. The subscription audit. Pull the last 2 months of bank and credit card statements and highlight every recurring charge. List each one with its monthly cost. Add the total. For most households, this exercise produces a number significantly larger than anticipated. Research consistently finds that people underestimate their subscription spending by substantial margins. The average gap between estimated and actual subscription costs runs between $80 and $130 monthly. Services that were set up during trial periods and never canceled, platforms used once and forgotten, memberships that made sense a year ago and have been unused since, all continue charging silently, automatically, and indefinitely until someone looks directly at the list. The Minimalist standard is to cancel any subscription not used in the past 7 days. Not the past month, 7 days. If it has not been opened or accessed in a week, the value it provides is not recurring value. It is theoretical value, the vague sense that you might want it eventually. Theoretical value at $14 per month is not $14 per month. Cancel it. Resubscribe if and when an actual specific use case presents itself. Ryan runs this audit every quarter as a calendar event. It takes 45 minutes. His most recent audit identified 3 charges he had genuinely forgotten: a software trial from 11 months prior, a streaming service he had signed up for during a free promotional period, and a cloud storage upgrade he no longer needed. Combined, $38 monthly, $456 annually, recovered from complete waste with less than an hour of attention. Habit 5. The 2 cards maximum. Carry 1 credit card for daily purchases and 1 backup card stored somewhere inconvenient. Cancel or freeze everything else. The financial content ecosystem has built an elaborate mythology around credit card optimization, reward stacking, sign-up bonus rotation, strategic category matching across multiple cards. For a narrow segment of highly disciplined, high-spending households who never carry a balance, some version of this generates genuine value. For the majority of households, the complexity creates far more risk than the rewards offset. Average credit card balances sit near record highs. Average interest rates on those balances sit well above 20%. A household earning 2% cash back on a card carrying a balance at 22% APR is not winning the optimization game. The interest expense is consuming the reward and a significant additional amount on top of it. The 2 cards maximum forces a simplification that makes spending visible. 1 card means 1 statement, 1 balance, 1 payment. The full picture of monthly spending is available without aggregation across multiple accounts. This visibility alone tends to moderate spending because the connection between individual purchases and the total monthly outflow is direct rather than diffuse. Habit 6. The single financial goal. At any given time, direct available resources toward 1 financial goal exclusively until it is complete, then move to the next. The personal finance content environment encourages parallel pursuit of multiple goals simultaneously. Build the emergency fund while paying off debt, while maxing the retirement account, while saving for a house, while starting an investment portfolio. Each goal feels urgent. The combined effect is that attention and resources are spread thin across all of them, producing marginal progress on each and completion on none. Single goal focus operates differently. All available resources beyond essential expenses flow toward 1 target until that target is hit. The sequence that works for most households starts with a starter emergency fund of $1,000, moves to eliminating high-interest credit card debt, then builds the full emergency fund, then captures any employer 401k match, then funds a Roth IRA, then increases 401k contributions to the annual maximum.
The psychological dimension matters as much as the financial one. Completing a goal produces momentum, a concrete demonstration that the system works and that the person using it is capable of following through. James hit his starter emergency fund goal in 3 months using single goal focus. That completion changed something in how he thought about financial goals generally. They stopped feeling like abstract aspirations and started feeling like scheduled outcomes with predictable timelines. Habit 7. The boring investment strategy. Open one brokerage account. Set up an automatic monthly contribution to a broad market index fund with an expense ratio below 0.1%. Leave it alone for 20 years. That is the complete strategy. No individual stock selection, no sector rotation based on economic forecasts, no tactical rebalancing in response to market movements, no reaction to financial news cycles. The data on retail investor performance relative to simple index fund strategies is consistent and unambiguous. Active retail investors consistently underperform the broad market over long periods, primarily because of emotional selling during downturns, transaction costs, and the tax implications of frequent trading. The index fund captures the market return. The active retail investor typically captures something meaningfully less while working considerably harder to achieve it. The minimalist investor checks the account twice per year. The market rises, they continue contributing. The market falls, they continue contributing. The boredom of the approach is its primary feature, not a limitation to be tolerated. Boring investing is almost always outperforming exciting investing in the background, while the exciting investor generates stress and activity in approximately equal measure. Habit 8. The annual bill reduction hour. Once per year, block 2 hours on the calendar. Call every recurring service provider, phone, internet, insurance, any subscription above a monthly threshold, and ask directly for the best current rate available given your tenure as a customer and your willingness to consider alternatives. Most service providers maintain retention departments specifically authorized to offer discounted rates to customers who express intent to leave. The discount rarely gets offered proactively, it requires asking. The annual hour of negotiation typically produces between $400 and $900 in annualized savings across the categories addressed. James was uncomfortable the first time he made these calls. The second time, the discomfort was minimal. By the third year, the ritual had become something closer to satisfying, a reliable mechanism for recovering money from companies that had been quietly increasing rates, counting on inertia to prevent pushback. Habit 9. The 60-second morning check. Every morning, before email, before news, before anything else, open the banking app and look at 3 numbers: the checking balance, the credit card balance, if any, and the savings balance. 60 seconds. No analysis, no action required. Close the app and proceed with the day. This habit addresses the avoidance pattern that underlies most financial deterioration. People who struggle financially share a consistent behavioral marker. They avoid looking at their accounts because the anticipated discomfort of what they might find makes avoidance feel like the easier short-term choice. The avoidance prevents the discomfort but enables the behaviors that make the long-term situation worse. Daily observation, even without analysis or action, neutralizes the emotional charge that makes financial information feel threatening. After several weeks of the morning check, account balances stop registering as judgment and start registering as information. Data points that naturally influence spending decisions throughout the day without requiring deliberate effort.
Ryan does not think about money particularly often. The system he built handles it. The transfers run on schedule, the index fund contributions process monthly, the bills pay themselves, the subscription audit happens once a quarter, the bill negotiation happens once a year. Between those automated processes, money is working in the background at a consistent, unspectacular rate, which is precisely the rate that produces meaningful results over the time horizons that actually matter. James, after consolidating his 6 accounts to 2, implementing automated savings, running his first subscription audit, and setting a single initial financial goal, described the change not primarily as financial, but as cognitive. A low-level mental background process that had been running continuously, tracking multiple balances, planning optimizations that never got executed, carrying vague awareness of financial disorganization, simply stopped running. The mental space it had occupied became available for other things. Financial stability in a complex economy does not require a complex system. It requires a simple one, simple enough to run automatically, simple enough to maintain under stress, simple enough that the number of decisions required each month is small enough to make consistent good choices across all of them. Build the foundation, automate the savings, reduce the complexity, audit the waste, and let time do what time does when the system is working rather than fighting you. That is the work, and it is considerably less work than most people expect.